Today we're going to review this 3-ticker portfolio from Vanguard. I was reading an article recently that someone put out, and they listed these 3 specific ticker symbols from Vanguard and these exact percentages on there. So I thought it'd be a fun idea to put them in the system and review how the performance actually looks. So here are the tickers here. So we have a total stock portfolio, international stock, and total bond market. Represented here, it's a 40-30-30 split. So first thing we always want to look at is the purpose of the portfolio. I'm assuming this is set up for growth. It's currently set up as a 70-30 split. So I guess you could use it for an income standpoint. The yield is about 2.4% per year. So it does generate a decent amount of returns here. Flipping back over to the allocation, we want to see what sectors we're actually being involved in here. So the major parts of the industry being representative is tech. About 25% of the portfolio is sitting inside the tech sector. Financial makes about 17%. And then looks like our next biggest one is industrials at about 11%. So those are the leading holding parts of the portfolio here. There's no cash in this portfolio, or very little, about 1% or so. There's a little bit of cash inside of these positions here, but for the most part, everything's either bond or stock. If you want to look at the region by region basis, about 60% of these funds are inside North America, and 40% are spread across the rest of the world. So I like the diversification going on here, and that you get a little bit of all the countries represented on Earth, because you don't want to miss out on the international market in the off chance that they do have better years than what the U.S. has had in the past. Now, if we want to look at it from a risk standpoint here, on a scale of 1 to 100 here, this one comes out at 52. All right, and it's saying probable, it's just estimating 25% out, 12% down. That's sort of the swing that it's had. Now, correlations, the nice thing with having 3 funds is there's not much overlap going on typically. So nothing is over 80 or 90%. They're not really correlated, which means they're all going to move in different directions. And that's kind of what you want in a portfolio. So this looks good here. Now, if we stress test against past events, so going back to things like the tech bubble, the World Trade Centers, the 08 crash, you can see that this portfolio is biggest risk is subprime mortgage part on here. Now, if we go back to this performance window here, and let's just look how it's done. So over the last 10 years, this portfolio has done about 153%, which, to put into layman's terms, if you had $100,000 10 years ago, it'd be worth $253,000 today. There's some pretty good growth going on in its portfolio. It averages about 9.7% of returns per year over the last 10 years. Now, if we push this back over a 20-year time period, which will include the 08 dip, our annual yield drops to about 7.3, but $100,000 back in 2006 is now $411,000 today. Now, if we want to zoom in to see what the last years look like, so last year did about 19%. So pretty strong return given that 30% of this was sitting in bonds and not all tied to there. If you want to compare it to like what the S&P 500 did for that same time period, you can see that S&P over the last year was about 15%. If we want to go specifically over 2025, so this portfolio did outpace the S&P 500 over the last year, but like anything else, it's hard to beat it every single year and beat it there. Over the last 5 years, you can see the bit of the reversion. So it's going to have some strong years, some years where it's under from the accumulation from that point. Now, this is a terrible comparison, so don't look at that there. That was showing 100% S&P versus something that's not 100% as well. Going back to here, we want to look at max drawdown over the last 5 years. So this portfolio in the last 5 years had a max drawdown of 23%. So this portfolio lost 23% at a given point in time. That was like its biggest loss. You can see in red here, it's highlighted from November 8th of 21 until October 14th, 22 when it bottomed out. Just 340 days of going down from your all-time high, and then recovery to go back up was about another 510 days. So you essentially peaked in November of 2021, and you didn't actually get your money back or see the same number in your account again until March of 2024. So again, this is more of a growth stock portfolio. If you're trying to generate income from this period of time might have been a little bit tricky from you. This is not showing any type of income distributions. And when you take distributions from a portfolio, it counts as negative returns. So this maximum draw would have been higher and the recovery would have taken even longer. So it's something to know if you're considering using something like this. If you look at the stats behind it all, we can see risks over the last 5 years is about 11%. So it's 11% swing, up or down. Here's your yield of 2.4, averaging 7% overall. And then we actually look at the Sharpe and this Sortino ratio. So for both of these, you're trying to look for the number 1 or as close to 1 as possible. And what Sharpe is reading is, of all the volatility in the portfolio, is it worth the risk? The question is trying to answer. So for every unit of risk I'm taking on, do I get an equal unit of return, for that unit of risk? So if it's a 1 for 1, that's when you get the number 1. This is 0.45. So if I take on one additional level of risk, or increase my portfolio by 1%, my excess return only goes up by 0.45. So it's a little bit on the weaker side as far as risk to return ratio here. And that's just the last 5 years. This one down here, the Sortino ratio of 0.75, that's a lot stronger. That's just saying of the risk we took on, let's not count upside risk. Let's just look at the risk that actually matters to us humans here, is when the market goes down, how bad is it? And is it worth taking through those downward swings? Because it's going to give me a better return in the long run. So this one spits out a 0.75. Every unit of negative risk or downside risk we experienced on here, we got a decent amount of return when things flipped. So Sharpe is basically saying how bumpy the road was. And the Sortino ratio is really just saying of the bumpy road, how bad were the bumps actually? So that's what we're measuring here. Now, none of this means anything unless you actually compare it to something. So if we go back to our asset class, we want to match it up, something to like a 70-30 split. So let's go in here and we'll pull just a 70-30 portfolio. This is pulling 70% SPY and 30% AGG, which is the aggregate bond index. So from given the same time period, instead of using this 3-ticker portfolio, if you just put 70% of your money in SPY or S&P 500 index fund, and another 30% in just some type of bond fund, you can see that for the most part, you would have been in this portfolio. You could have had even less funds, but also had more performance. Now, performance is great, but you always want to look at risk when associated with that. So if we look at the score here, the 70-30 is actually slightly riskier on the score matrix. So we had more performance, but we also took on a little bit more risk. So that might not be something you're wanting to look at unless the risk is worth the reward. And that's why we look at things like the Sharpe ratio. So we have a 0.61. So even though this portfolio was a little more risky like we just saw, it gave us a better return overall. So it said it was worth it. The added risk that the portfolio took on gave us better returns, making it worth it. You can see the Sortino ratio is actually over 1. So you would have essentially a smoother ride inside of the 70-30 portfolio versus this 3-ticker Vanguard. On top of that, we can see that it performed at 60% over those 5 years, having 9% overall. Max drawdown was only 21%. 291 days to recovery, 291 days of downside, 439 days until you came back up versus 510. So it's about 70 days or so there. So over 2 months is how much longer the Vanguard portfolio would have taken for it to get your money back versus this one here. So if we put it to the value again, you can see the difference there is having $144,000 versus $160,000 had you started with $100,000  5 years ago. Now, if you look over just the last year, the Vanguard strategy did outpace it. Over the last 3 years, you can see the difference there. And the further back you go, typically the wider the margins you're going to see. So it wasn't always this way. You can see over here it was pretty close. But it looks like when the markets go down, the index typically looks like it responds a little quicker to recoveries. And it's a little bit slower. So they mirror each other going down, but it doesn't seem to drop as much. So in this case, it essentially underperforms this benchmark here, although it does have a slightly less risk involved in it. Does that mean you shouldn't abandon this? I would say no. This is actually a pretty solid lineup that you have going on here. The goal is never to always just beat the index. It's what works for you and what works for your goals. If this 3-ticker portfolio symbol accomplishes that for you, then that's something you should feel confident being within. So this lineup here, it looks pretty strong overall, though it does, underperform the benchmark that we're comparing it to here today. Now, if we want to look at expenses on here, it's Vanguard, so it's not much. 0.17 is the highest fund here. So it's a pretty low cost portfolio that we have going on here. Now, if we look at our tax drag here, we can see that this Vanguard fund, it does have some type of taxable gains on here. So it just means that the income it produces would obviously be taxed on here. Again, if this is a retirement account, then I wouldn't really worry about that too much here. Now, if we go back and look just at its performance, can a normal person hang on to this portfolio? If we look at it from a year-to-year basis, 2025 up and to the right, so that's not hard. Look at 2022. You can see we dropped 16%. So can you actually stomach that type of downfall here in just 1 year? So that's really what you got to get at and ask yourself. While it does have good upside that we've seen when we looked at these charts in the past, remember that the market cycles, there's going to be good years and bad years, and you got to be able to stomach these bad years to get these good years overall. And losing 16% in 1 year and getting 16% back next year, you're still at a loss because you have to make more, because when you lose money, it takes a higher gain to make up for that loss overall. So if we look back to this 5-year window, we can see the loss in 22 at the end of 23 here. It still has not caught up to where 22 started off yet. So you can still have some sideways in here. If we go back 10 years, the drawdown happens during the COVID time in 2020. Recovery's a little bit faster on there. And if we push back to the 2008 crash, you can see this portfolio during that market crash went down 42%, which lasted almost 495 days of just constantly losing money, and recovery took 676 days overall. So from October of 2007, you wouldn't get your money back until January of 2011. So it's a little over 3 years of straight sideways action where nothing's really happening here. And we back it up some more, so you can see the dot-com bubble burst. So there's a lot of sideways chop going on. Lately, it hasn't been the case, but you should always be prepared for that when building out or selecting your portfolio investments. So as far as what's working good in this portfolio is I like the simplicity of it. It's only 3 tickers. It's pretty easy to manage. It covers the United States as well as all the other countries in the world. So you're getting really good exposure across the board. As far as the style, you do have some mid and small cap sectors. You are exposed to those sectors when they grow, the majority being up here in large caps. So it's fairly low risk play. You're investing in the bigger companies once they're probably gonna be around for a long period of time. So that's pretty good here. Now, if we look at a plot chart, we want to make sure that these investments, that we're getting the appropriate amount of compensation for the risk we're taking on. So you can see how this one sort of lags. It has less risk and less return. This one has more risk, more return. So that makes sense. If we're going to take on more risk, we want to see a higher return. We don't want to see this one down here. This bond one over here, this isn't a true representation because this only captures total market performance. It's not really looking at the yield generated. So it says it's flat. It's actually generating that yield. So I wouldn't worry too much about this one here. Same thing, we go back 10 years over time, you see how it's lost money. Or I guess it's up very little here over time. These funds seem to be working fairly well on here. As far as changes I would make, the only thing I would play around with personally, so if you really want to go into it, was just looking at the Sharpe ratio, try to get closer to 1. I'm on the 10-year chart here. We have 0.7, 1.18, so last 10 years looks okay. If we go a little more recently though, this is when we start dropping to less than half. So that could potentially mean that something might have shifted, and this maybe we need to add different ticker symbol, make it a 4 ticker symbol, or swapping these out for something that might be performing or invest a little differently. So I would just explore ways to perhaps get a better return given the amount of risk that this portfolio is taking on. Because as we saw earlier, it is trailing the equal comparison of the 70-30 stock to bond overall in these categories. And it looks to be consistent year over year, 3-year, the 5-year, even the 10-year is trailing in terms of overall return, average return. The only thing it's beating it at is yield, and that's because the aggregate bond thing that is tracking isn't showing yield, but it's losing in those type of categories. So this says that there might be room for improvement, and so that might be something to explore further. If you guys need help analyze your portfolios, or you want to dive deeper inside of this one and see what it looks like when I compare it to a custom built stock portfolio, that's all inside of the Washington Wealth Breakthrough Group. It's free to join. The link to do that is in the description below. I look forward to seeing you guys next time. Remember that your future depends on what you do today.